Welcome along, everyone. Some of you may be aware that we've just wrapped up our roadshow around the country in Auckland, Christchurch and Wellington, and we got some really good feedback from clients and wanted to record it essentially so that we could provide the same content to all of our clients. Now, before we kicked off the roadshow, we sent around an email to clients to get an understanding of the sort of questions that they wanted us to answer, and we've created some content around that, which I'll be presenting shortly, and we also have a short panel discussion to dig into your questions in more detail. So to start off, we'll provide an update on what's been happening in markets in 2023, and this year in financial markets thankfully has been very different than 2022. Now, if you've been following the share market closely this year, you would have noticed there's been this real theme of technology and innovation. And in fact, I'll share a slide shortly which essentially shows that most of the gains in global share markets have been driven by a handful of companies that are benefiting from some trends in innovation and technology. Whether that's a company like NVIDIA, the silicon chip manufacturer, which is benefiting from the AI boom, or whether it's some of the big cloud computing providers like Amazon or Microsoft, they've all been benefiting from some of these innovation themes, which we'll talk about shortly. Now, just starting off on this theme of innovation, if you were to reflect back 100 years and think about what the biggest innovation or discovery was, this time 100 years ago, what would it have been? Was it the automobile? Was it the aeroplane? Was it penicillin, or was it the transistor? And we asked this on our roadshow, and actually quite a few people in the audience to get the correct answer. And the correct answer is, of course, penicillin. Now, penicillin actually was invented in the 1920s, somewhat by accident, by this distinguished gentleman you can see on screen here, Dr. Alexander Fleming. And it was discovered in the 1920s at St Mary's Hospital in Paddington in London. Now, penicillin was the first ever antibiotic, and it's still widely used today. And what you may not know is that over the last 100 years, it's saved about 200 million lives. So it was a massive breakthrough for society. Now, Sam, my colleague, will present shortly on this theme of innovation more generally, but also specifically some of the innovations that we've been seeing this year in areas like artificial intelligence and some of these weight loss drugs and how they're impacting the technology and medical sectors. But firstly, I'll start with an update on what's been happening in financial markets. And if you reflect back to this time last year, and you can see on the screen here, we've got a few headlines from the Financial Times, essentially showing what people in markets were focused on this time last year. There was quite a negative backdrop. There was a widespread talk of an imminent recession that everyone was expecting. Inflation was still extremely high. You can see here it was 8% in the US. And as a result of this high inflation, central banks hiking interest rates really aggressively, and concerned that this inflation might actually stay higher for longer, share markets had been in free fall. In fact, the MSCI World was down about 21%. And as a surprise for perhaps conservative investors who usually see their balances move around a lot less, fixed income markets, which make up a large portion of conservative portfolios, had also fallen about 20%. And to put that in context, that's the biggest fall in bond prices in recorded history. So this time last year, investors were pretty pessimistic and investor sentiment was very weak. Thankfully, this year has been a much better year for investors. As you can see on the slide here, global share markets are up pretty significantly, whether that's the US or Europe, and in particular growth companies or technology companies, or the NASDAQ index is up really significantly, up 26% for the first 3 quarters of the year. And the reason for this essentially is that inflation has started to come down and the much predicted recession hasn't played out. Now, moving on to the next slide, while the global share markets have been stronger, you can see that the New Zealand and Australian share markets have been a bit weaker. And one of the reasons for that is the New Zealand economy and the Australian economy is a bit more sensitive to interest rates. In this part of the world, house prices are higher, we tend to have larger mortgages, and also those mortgages tend to have only reasonably short-term fixed mortgage rates. So the impact of increasing interest rates is felt more quickly in New Zealand and Australia than it is in other markets like the US. The other thing you can see on the slide, the far right-hand bar, is that global bond markets have fallen again this year. And I'll come back to this shortly. But the question we get from our clients quite a lot is, it still feels pretty nervy out there. Why has the global share market done a bit better this year, despite the fact that we're not out of the woods yet in terms of the global economy? And there really are 3 reasons for this. The first 2 you can see on this slide here. Essentially, the first is that inflation has started to come down. About a year ago, it was 9% in the US. That's dropped all the way to about 3.7% at the moment. So inflation is more than halved in the US, and we've seen the same thing happen in Europe, the UK, and also in New Zealand. Inflation started to come down from the sevens to the sixes, and now 5 point something. So inflation is coming down all around the world. Now, the second thing, the chart on the right-hand side here shows the US economy, which is a big part of global share markets. And despite this widespread forecast of recession, we've actually seen retail sales continue to grow. House prices are still going up in the US. GDP is ticking along nicely. So the underlying drivers of the economy are still reasonably strong, and unemployment is still extremely low. But a third thing that's been impacting markets behind the scenes on the next slide, as I mentioned earlier, is some of these big tech companies really rallying strongly and lifting global markets. So the chart here shows the top 7 tech or growth companies in the US, and these 7 companies together on average have delivered a return of about 55% so far this year. Now, if you took just these 7 companies out of the S&P 500 and looked at the other 493 companies, you would see that basket, the other 490 odd companies, has barely moved, and it's only up about 2% so far this year. So these tech companies, driven by some of these innovations that Sam will talk about shortly, have really been a big driver of markets. Now, in addition to markets rebounding, this next slide essentially shows that our funds have had a really good year as well. Whether that's our managed funds or our KiwiSaver funds, not only have they rebounded in line with markets, most of them have also significantly outperformed global markets. Interestingly, in New Zealand and Australia, which I mentioned earlier, where share markets have been weak, our New Zealand and Australian share market funds have actually still delivered really strong positive return for investors. And interestingly, you'll see the income fund, despite the fact that bond markets have been pretty weak this year, our income fund has still delivered a positive return for clients and a positive return of 4.8%. So the fixed income team have been able to select the right securities to deliver still strong returns in fixed income markets, despite the fact that bond markets have been weak. Now, one final topic that's worth covering in more detail, because we have got lots of questions from clients about this, is just to cover the fixed income market and what's been happening there. Now, I'll bring up a slide here, and essentially you can see that historically fixed income returns have been stable, and the chart on the left-hand side shows the returns every year for the last 50 years from US government bonds. And you can see what you'd expect from fixed income investments is they generally deliver a positive return. There aren't many negative years, but the returns are a bit lower than you'd expect from the share market. So over that whole period, the average return's been about 6%, and particularly at the start of that period, it wasn't very volatile at all. But because it is a lower return and lower risk asset class, not many investors would have expected what we've seen over the last 3 years, which is 3 years in a row of negative returns from fixed income, which you can also see on the chart. And that dynamic has created a lot of investors to really rethink fixed income and ask the question of whether or not fixed income still should play a part in portfolios. It is important to remember, though, that all of that's in the past, and actually the best predictor of future returns on fixed income assets is the starting yield. And because interest rates have gone up so quickly, the starting yield on those securities is a lot better at the moment. And you can see that on the chart on the right-hand side. Our income fund 2 years ago had a running yield of about 2.1%, and that's jumped all the way to 7.5%. So the outlook for fixed income investments from here is a lot stronger than it was, and we do believe fixed income will start to play that role of providing ballast in portfolios again. And that's a real positive for savers and people in retirement, because for the first time in over a decade, you can now get a decent real return on fixed income investments. Now, just briefly on the outlook, having said all of that and painting an improving picture, there are still some storm clouds on the horizon. Whenever interest rates go up quickly, like they have recently, there's always the risk that impacts the economy and leads to a recession. Having said that, we're not out of the woods, and there still is a risk of recessions in certain parts of the world. But overall, 2023 has been a good reminder that bear markets don't last forever, and often the best time to be investing is when people are pessimistic, as they were this time last year. But the key thing is, last year's 2 biggest concerns, that inflation would stay high and that they would have a deep recession or would have the stagflationary environment, they haven't played out. So there certainly is room for more optimism from investors. And despite the rebound in markets, share market valuations are still reasonably attractive. So when we look around the world, the global economy is more stable than it was, and we're finding lots of interesting businesses that are still growing, trading at reasonably attractive valuations. and this makes us optimistic about the future returns for share market investors. Before we get into the panel discussion, start doing some Q&A, I wanted to get Sam to talk a bit more about this theme of innovation and how we're trying to invest behind that.
Thanks, Ash, and hello and welcome everyone. Now, when my grandmother Zita was born 102 years ago, she travelled to school by horse and cart. And she'd never heard of this penicillin that Ashley talks about. And the average life expectancy in New Zealand at the time was around 50 years of age. And even more recently, when I started work, which as Ash kindly reminded me, wasn't that recently ago, we sent faxes. We occasionally sent an email, but you had no idea whether that email was going to come back from the ether. And mobile phones were the size of a brick. The point is, the pace of innovation is rapid and it's getting faster. So what are these innovations we're seeing that are moving stock prices in the market right now today? And more broadly, how do we think about investing alongside and behind innovation? Innovation drives economic growth, and economic growth absolutely drives corporate profits. And corporate profits are the primary driver of stock prices in the medium and long term. Now, this chart you can see on the screen here is 2,000 years of history of global economic growth, and it's done on a per capita or per person basis. And the astonishing thing to me is it just didn't move for 1,500 years. And then you can see after the year 1800, it exploded to the upside, and that's really innovation driving that. So think of the Industrial Revolution, steam power, the combustion engine, electricity, the internet, huge advances in medicine and drugs. And all of this has significantly lifted living standards around the world and lifted billions of people out of poverty. And the pace of innovation we have seen this year gives us confidence that innovation is going to sustain economic growth for the medium and long term. So two of the innovations we're seeing in the market right now today that are moving markets are generative AI and obesity drugs. Generative AI was a hot topic earlier this year, and you may have heard of the launch of ChatGPT, the smart chatbot launched by Microsoft and OpenAI last year. Now, AI has been around for a very, very long time, and if we think back to the 1940s, The Wizard of Oz, the Tin Man was dreamt up based upon AI, but AI has always struggled with creativity, and generative AI has changed that. So the image you can see on screen here was an entry in the Colorado State Fair art competition. Now, the interesting thing here is this wasn't painted or drawn, but it was generated using AI. And the artist simply typed into an AI image generator, space opera theater. And this was created unbeknownst to the judges, and they awarded first prize to this. And you can imagine the controversy this caused. But if we think much more broadly here, generative AI has the ability to drive huge productivity gains for society. And one simple example is software developers, computer engineers. They're more than twice as productive when they use generative AI as a co-pilot. Now, it can take 10 to 15 years and cost billions of dollars to bring potentially life-changing drugs to market. And there's 6 trillion potential organic molecules that can be used to create life-changing drugs. Now, that's interestingly as many grains of sand as there are on Earth, and generative AI is doing a great job of sifting through those grains of sand to figure out which of those molecules can most easily be created into drugs. So the benefits for society are potentially huge, and we need to look back at previous game-changing technologies as a blueprint for what could possibly happen here. So take the automobile, for example. In its narrowest sense, it took grandmother Zita's horse and cart off the road. But if we think much more broadly than that, the car allowed us to live further from cities. So it drove the development of highways, suburbs, and even shopping malls. So we need to think really broadly when we think about these innovations. The other big innovation that's been moving stock prices right now today is these obesity drugs. So the manufacturers Novo Nordisk and Eli Lilly are up 50-60% this year. And on the flip side, which is equally important, the perceived losers from these obesity drugs are down 30, 40, 50%. So there's a huge spread of outcomes there. Interestingly, these drugs have been around for years, and they were used to treat diabetes from 2010 onwards. But a curious side effect of these drugs was that they caused reasonably significant weight loss. So Wegovy, Ozempic, and Mounjaro, via their clinical trials, are showing 15 to 20% weight loss in patients. So the much bigger news is that these clinical trials are showing material health benefits from these drugs. So a 20% reduction in major cardiac events, so like heart attack and stroke, and much improved kidney health. Obesity and comorbidities is a major issue for society, and in the US, almost 40% of adults are technically obese. And obesity costs the global economy $4 trillion a year in both lost productivity and direct healthcare costs. So if these drugs live up to their billing, they could be game-changing indeed. So there's several ways to invest alongside and behind innovation, and the first one is simply picking the winners. It's important to note that we're not at the bleeding edge trying to pick these winners, because history tells us that can be quite expensive. So take the dot-com burst, for example, or the bubble burst back in 2000, and names like Yahoo, AOL, and Pets.com were lauded as the winners of the internet age, and their stock prices and valuations rose to astronomical levels. Roll forward a decade, and those companies basically didn't exist. So take Google, for example. The company didn't actually list on the stock market till 2004, and it wasn't till 2007 that it became clear Google had actually won the search wars with an 80% dominant market share. So the company had actually won in 2007, and if you bought that winner then, you still would have made 7 times your money. So absolutely we can pick winners. It just doesn't have to be at the bleeding edge. Now, the second bucket of ways to invest behind or alongside innovation is by buying the picks and shovels. Now, you might remember that famous saying back in the gold rush days that the safest way to get rich is not necessarily by mining for gold, but by selling the picks and shovels to the gold miners. So today, the picks and shovels are the infrastructure providers to the innovators. So the beautiful thing about the picks and shovels is they benefit regardless of who wins. And the third bucket is try and avoid disrupted industries. So the horse and cart, Zeta's horse and cart was absolutely disrupted by the automobile. You might remember Blockbuster Video. Well, that was disrupted by Netflix. And the market is telling, it's early days, but the market is telling that the losers from these game-changing obesity drugs are companies involved in the delivery of insulin or kidney dialysis. So we own several picks and shovels in our international portfolios, and you can see that on screen there now. The first bucket of picks and shovels are the data center providers. So AWS and Azure are owned by Amazon and Microsoft. So these companies provide the data center infrastructure for innovative AI developers to build and scale their applications on. And again, they win regardless of which one of those developers wins. Another great pick and shovel is Icon that you can see on the screen there. Now, Icon's a clinical research organization which helps major drug companies around the world test the efficacy of potential new drugs. Now, we've actually owned Icon for 15 years in our international portfolios, and the stock is up 7-fold since we've owned it. So there is very attractive gains to be made by buying the picks and shovels. The other way we're currently playing innovation is by buying industry leaders, and a good example is Meta. So Meta's been using AI in its products for about 7 years, and more recently has been supercharging the use of generative AI in its products. And what does that do? It does 2 things. It puts more relevant content in front of the appropriate user, which drives better user engagement and attracts new users. And it also allows its advertising customers to more rapidly spin up targeted ads for those consumers. So you get a better return on ad spend for those customers, which makes them stickier and in turn widens the moat. So we added up all the money that Fisher Fund's portfolio companies spend on R&D, research and development, which is kind of like innovation spend, and that comes to 330 billion Kiwi dollars, which is almost the size of New Zealand's GDP. So just a quick reminder to us, what does R&D or research and development spend do? It enhances existing products to make a better experience for the existing customers, but it also creates new markets and products to lengthen the growth runway and widen the moat. Now, we put that $330 billion in context, and that equates to about 10% of the revenue of those portfolio companies. And by way of comparison, the entire US economy spends about 3.4% on R&D. So you could say that Fisher Fund's portfolio companies are 3 times as innovative as the US economy. In some cases, that number's much higher. So take Xero, for example. They spend 35% of revenue on R&D. And what does that allow them to do? It allows them to dominate the cloud accounting market globally outside of the US. And what was super interesting is during COVID, when demand fell off a cliff for all companies, and all companies around the world were cutting costs, Xero was no different, but they didn't touch their R&D budget because they know how important innovation is to the future of the company. So, innovation is super important. Our companies are super focused on it, and we're super focused on it. And innovation has absolutely driven economic growth for the last 100 years. And what we're seeing right now in the market today gives us confidence that innovation can grow and drive economic growth for the next 100 years. Now, as always, there's many things to be excited about in markets and many things to be concerned about. And you and our other clients from around the country have been brilliant. You've sent in your burning questions around investment and advice and markets. So we're going to have a panel of experts up on stage here to help answer your burning questions.
Welcome everyone. We've just finished our roadshows around the country in Auckland, Wellington and Christchurch, and it's been great to have many of our clients there. We thought it'd be good to record the content that was there in the evenings so that all of our clients can enjoy it. So welcome to the team. So today we've got Ashley Gardine, our Chief Investment Officer, Sam Dickey, one of our Senior Portfolio Managers, and Laura O'Reilly, one of our Senior Wealth Advisors. So we'll be asking many of the questions that you have sent in and asked us. So let's get going. So I'm going to start with you, Ash. To start off with, we've painted quite a long-term optimistic future, but in the advice team, we're getting a lot of questions about the here and now and whether portfolios are at risk from a potential recession. So how worried should we be about that?
Yeah, we do often talk optimistically about the future because when we look at the companies that we're invested in, we actually see a lot of growth ahead for those businesses. I guess though, you always have to think about the here and now as well. And there are some risks out there that people are focused on. In New Zealand here, we've obviously seen house prices come down, retail sales have fallen a little bit, and there are still question marks about whether we'll have a recession. I guess though it is important to always separate the economy from markets, and whenever there's question marks around the economy, asset prices are typically lower. So share prices, house prices, bond prices are all well below their peaks, and essentially that means for investors that are investing now, they're buying in at better prices. So there's always a difference between what might happen in the market and what's happening in the economy.
Yeah, thanks Ash. So Laura, we're getting a lot of questions this time from clients that are either near retirement or in retirement, and they are wondering what they should be doing. So any thoughts from you on what is the right way to invest as you approach and enter retirement?
Yeah, well, I think the magic really is in figuring out how to combine all those different kinds of assets people have to meet both their shorter and longer term income needs. So retirement, clearly it's just not what it used to be. When we see clients come to us now, not only are they expecting a longer amount of healthy years than their parents, but their lifestyle expectations are often a bit higher as well. So what that means is they really need to figure out how to stretch out that nest egg for as long as possible. They come to us and they've spent a whole lifetime working and they've got all sorts of assets, from your cash savings and property to potentially even KiwiSaver and managed funds. And figuring out the right way to combine all of those assets actually can be quite daunting. And in isolation, there can be downsides to any one of those options. So if they are confused, I think it's always a great idea to seek out advice. Assets aren't always going to perform in the same way at the same time, we know that. And that's why you really want to make sure that you spread out your eggs across multiple baskets. For example, you've got your cash and term deposits, and they are really great for money set aside maybe for the shorter term. Then you've got other income assets like bonds, and they add a bit of extra diversification, potentially a higher yield for a longer duration of time frame. Then come in your growth assets, which provide that really important long-term potential for capital growth and inflation protection. So we're just putting up now a chart, and it shows the value of $100,000 invested for about the last 20 years or so. The bottom lines represent cash and term deposits, and then the top lines that are a little bit more jagged, bit higher ups and downs, they are of course representing share market returns, in this case the New Zealand and US share markets. But what I want to draw people's attention to is that middle line, because it represents a composite that is a 50-50 mix of term deposits and share market returns. And what you'll notice is that, that the end return isn't quite as high as just investing in shares, and there still are some bumps along the right way, but overall that path is a little bit smoother. And it just shows how powerful taking a more diversified approach to investing can be over a long period of time. And the beauty of KiwiSaver and managed funds is that they just help to make that diversification a little bit easier. And our job as advisors is to sit down with people and help them go through their options and figure out the right fund for their situation.
That's great. Thanks, Laura. So what I'm hearing is the key to investing in retirement is ensuring that you've got the right mix of investments as your time frame and income requirements change. So what about clients that are worried if they've got enough money for their retirement at all? What do you say to them?
Yeah, and that's an important question to be asking. The answer to that will be different for every client. Some people come to us and they already know they've got more than enough set aside. So their focus then becomes more about, okay, how do I optimize this for the next generation? And then we get other people who come to us a little bit earlier and they know that they're going to have to come up with quite a good, strong plan to get to where they want to go. So when we do have someone that comes to us with a bit of a lump sum and they're thinking, okay, how can I invest this for retirement? Quite an important part of our advice process is to sit down with them and do some portfolio projections, just to give them a bit of a peace of mind for the road ahead. So we'll sit down and look at what's important to them, what income they're going to need and when, and maybe what their other financial goals are, and then set them up with a bit of a blueprint. So obviously projections are just an illustration, they're not a guarantee, but they are a good way to take stock of what's possible. And they're also a great way to get a bit of a signal in advance if you think you're going to need to make some adjustments just to get to where you want to go.
Yeah, that's great. So really important to get advice when you need it and work out what's going to work best for you. Sam, a very topical question for you. What are the implications of the election outcome for investors?
It is topical, Kath, and the answer I think is probably not much. So the implications for New Zealand investors of the New Zealand election is not much. And why do I say that? So we've looked at a few different things. The first thing is a good proxy for asset prices in New Zealand is probably the Kiwi stock market and the Kiwi dollar. And if you look back over the last, say, 21 years, 8 election cycles, on average, 1 week later, those asset prices were flat. So that's the first thing. The other thing we looked at, Kath, was looking at the entire parliamentary term and splitting the returns of the Kiwi stock market versus global stock markets by a national-led government or a Labour-led government, and there just wasn't much difference in the returns there. And the final thing we've looked at more recently is national specific policies around some of our more politically sensitive or economically sensitive companies, like the retirement village operators, like the electricity generators, and there's just not that much there to impact stock prices.
Great, thanks, Sam. What about further afield, US presidential election next year? What are your thoughts on that?
That's right, November next year, and it will be topical for the media, absolutely. But I think if we think about the election of Donald Trump in 2016 as a great example of where playing politics or even geopolitics via the stock market is quite fraught. So firstly, the market was convinced Donald Trump wouldn't get into power. And secondly, the market was convinced in the unlikely event he got into power, the stock market would go down, it would tank. So as it turns out, the market was wrong on both counts. He did get into power and the stock market went up 21% in the year following his election. So these things are really hard to predict, and they're certainly hard to predict how they'll impact markets. So I think the view is that you should absolutely not construct your long-term portfolio based around geopolitical or political events.
So if we're thinking about interest rates, Laura, so interest rates are much higher than they were a year or so ago. And with high interest rates, many of our clients are asking, should I be thinking about term deposits?
Yeah, it's definitely a popular question this year, and understandably so. I mean, term deposits, they've got their place, but they're just not a great way to actually grow wealth over the long term, so they're not going to be an all-in-one option for most clients. Term deposits are a most suitable option if you know you're going to need to access the funds within the next couple of years, or where the absolute safety of the funds you're putting aside is your biggest priority. What I tend to find is that as an advisor, many clients will hold both term deposits on one side alongside a longer term, more diversified portfolio. And I think that's quite a good approach to take. So the question isn't so much, should I have everything in term deposits or everything in funds? It's more about, okay, how do I find that balance between my longer term and my shorter term investments? Term deposits are great at holding wealth, and it's a low risk way of holding wealth, but they're just not a great way to actually grow wealth over the long time. And that's because inflation can really eat away at your spending power over time. And even if you do get a great rate, there's no guarantee that you're going to be able to get that again when it rolls over. So on the screen, what we're showing is how quickly even a 3% inflation rate can really eat away at the real value of your money and your spending power over a 25-year time frame, which is about how long we plan for when we model out the length of retirement. As advisors, our job is to maintain that longer term view for our clients. So we're not just trying to achieve the best return over the next 12 or 18 months. We're thinking about, okay, what is the best strategy going to be for this client over 5, 10, 20 years or longer? So inflation protection is going to be a big part of that for most people. So while term deposits can be a really useful tool as part of a well-diversified portfolio, they're just not an all-in-one option, and it's important to remember that.
Yeah, so that diversification is key, and really having some inflation protection. Great, thank you, Laura. Sam, we're nearing the end of central bank hikes. So what does that mean for fixed income investors?
So Kath, it's probably worth reminding ourselves how torrid the year was last year for fixed income investors. And as a simple equity guy, I always remind myself, as interest rates go up, bond prices go down. And it really is that simple. And a reminder that last year was the sharpest rise in interest rates in 40 years. So it was painful. The good news, though, is the starting point for bond investors, for fixed income investors, is much more attractive. So take our income fund, for example. Back in 2020, the running yield on that was only around 2%. Today, that number is between 7.5 to 8%. So if we dig under the hood, what makes up, what are the companies or the investments or the bonds that make up that 7.5% running yield? And a good example is Verizon. So Verizon's one of the biggest telecommunications companies in the world, listed in the US. It's a bit like Spark here in New Zealand. So it's a full-purpose, fully integrated telco, and by definition, those telcos have pretty predictable revenue streams, so they're investment grade. And when you think about that context, you can invest in their 2039 bonds and achieve an 8.3% yield for the next 16 years, so it's pretty attractive. But getting back to your question, Kath, are central banks on pause? The answer is, on the whole, yes. And the reason I say that is twofold. Firstly, central bank governors around the world are telling us so, and that's quite different from what they've been telling us for the last 18 months. And the other thing is the forward rates market is pricing it. The market's pricing this. So the market's actually not only pricing a pause, it's actually pricing here in New Zealand and the US a cut in rates. So taken all together, the starting point's more attractive. And if those rate cuts come through, then the opposite of what I said at the start is true. We could see interest rates going down and bond prices going up.
Thanks, Sam. Ash, I've got another question for you. And we're actually getting quite a few questions from clients around the Chinese economy. So what are you thinking about China at the moment?
Yeah, thanks, Kath. We do get a lot of questions about China, and I think one of the key reasons for that is just everyone knows it's a really big trading partner for New Zealand, but it's also very important for the global economy. I guess the first thing to say is that we don't actually have much direct exposure to China in our portfolios. In the international fund, we have a handful of Chinese companies, but generally Chinese companies that are listed on foreign exchanges. And the reason that we don't have much investment in China isn't so much a view on the economy. It's more that the criteria we look for in businesses and the corporate governance that we require, it's just harder to get the same quality of businesses in China as it is in the US, New Zealand or Europe. But the reason that we get asked this question about China a lot is because it is a really important country globally, and it has driven a lot of global economic growth. But you'll see on the slide that we've got up here that economic growth in China, it has rebounded since COVID, but it hasn't rebounded back to the previous levels that we used to expect from China. And people were a bit surprised by this because when we saw the reopening in the US or New Zealand, we actually saw a really sharp snapback in consumer spending and GDP growth because people had been unable to travel, unable to go to restaurants for a long time, and actually the economy really bounced back to life in the rest of the world. So when China finally reopened again, everyone was expecting something similar. We didn't have that in China. And part of the reasons for that is essentially the property market has been a lot weaker in China. And property, a bit like New Zealand, is a really important asset class in China. About 80% of personal wealth is tied up in property. So when property prices are weak, people don't feel like spending.
So Ash, what about the government? What are they doing about it?
So it is, China's still a centrally planned economy essentially, so that the government is highly involved and they obviously want the consumer to do well. And the important thing is the consumer did actually build up quite a big cash buffer during COVID. They just haven't had the confidence to go out there and spend it. So the government are doing a few things to try and spur the economy back into life. They've removed some of the restrictions they had put in the housing market. They're changing lending standards essentially, and they've been dropping interest rates. So those things combined are starting to have a bit of an impact, and we're starting to see consumers think about spending again. And if that confidence comes back, they do have significant bank balances to spend, and that should help the economy reaccelerate.
Laura, you've talked about the shorter term versus the longer term investing, and I think that's really important. So obviously time frame is a really important factor. Can you tell us a bit why time frame is really important for our clients to consider?
Yeah, thanks, Kath. Defining your time frame is absolutely key, not just to choosing the right strategy, but keeping in mind can really help to manage the more psychological challenges, should we say, of the ups and downs along the way when you're investing. So when you've got a longer term time frame, you've got a bit more capacity to take on risk because you've got the ability to hold on through any challenging times in the markets. Whereas if you've got shorter term money, it's got much less ability to actually regain any losses if you needed to take it out immediately. So when you're thinking about this, it's just important to remember that different kinds of asset classes have got different potential for growth over time. For example, shares have really outperformed bonds over the long term, but in the short term, they carry quite a bit of extra risk. So for example, on this chart that we've got up now, you can see the performance of the US share market as represented by the S&P 500 since about 1946. So those light grey shaded parts there are recessions. You can see that there's been plenty of peaks and troughs along the way. And if you zoomed in and took a snapshot of any one of those trough periods, it would look a lot more sharp and probably look a little bit scary. But despite that, when you zoom out over that longer term period, you can see that the long term trend has actually been really positive. So that's why understanding and remembering your time frame is really key to investing, right up there with understanding your attitude towards risk.
Yeah, that's great. Thanks, Laura. So time frame's key. Sam, where are you seeing opportunities in the equity market right now?
Yeah, great question, and that always gets us pretty excited because we come to work every day to pick stocks. So I'm going to give you an idea straight away, which is Danaher. It's not a household name, but it's a high quality company that's been a little bit unloved recently. But just before I go into that, Kath, I'm just going to take a little bit of a quick step back and just remind ourselves, certainly our new Fisher Funds investors, of the three lenses we look at stocks through, or the three pillars. So the first one is wide economic moats. So great businesses that can elbow out competitors, and an easy example is Auckland Airport. It has a monopoly on international airports in Auckland. They're just not going to make another one. The second lens, the second pillar, is we invest behind companies with long growth runways. So a great example of that is Amazon, which one of its biggest, most profitable businesses is Amazon Web Services, and the shift to the cloud, which drives that business, is only around 30% done, so a long way to go there. And the final lens is we absolutely invest behind companies with talented and aligned management teams. Back to Danaher through those three lenses. First of all, Danaher is a medtech behemoth in the diagnostics, biotech spaces, and I guess simplistically, if you took a COVID test in the early part of COVID and you went through one of those drive-through testing stations, chances are that sample would have been tested on Danaher equipment. So its moat is absolutely its scale. It operates through 20 operating companies into very attractive end medtech markets, and it's number 1 or 2 in all of those markets. And it's really more than that, though. It's the huge amount of know-how and research and development and patents that have been built up over many, many years in all of those different companies. So simplistically, Kath, you and I could never compete with that, no matter how much capital we had behind us. On the growth runway, if you look up on the screen there and you look at the explosion in gene therapy trials that we're seeing both today, and you can see that continuing for the next 20 years, Danaher is the enabler of this. So we talked earlier about generative AI and how it's sifting those grains of sand to develop game-changing medicines more quickly. Well, Danaher is the enabler. With its processes and systems, it helps drug companies develop drugs more rapidly. And finally, on the talented and aligned management team, this sounds really simple, Kath, but it's really, really hard to do, is they have this myopic focus on continuous improvement. So everyone from the CEO to the newest factory worker comes to work every day and just does things a little bit better, and that's actually the envy of companies around the world. So we've actually followed that as a team, that company, since 2017, and more recently it underperformed the NASDAQ, for example, by around 40%, so we took the opportunity to invest.
So thanks so much, team. It's been great to have all of the questions answered. Thank you very much to all of you. If you do have any questions or want any advice following today's presentation, then please do get in touch. Any of the team at Fisher Funds will be able to help out. So thank you.
Great, thanks for that, Kath. Really appreciate you firing all those questions at us. And I thought I'd try and pull all of that together into a few key thoughts because we did cover a lot of material. The first one is this year in financial markets has been very different than last year. And thankfully, inflation has started to come down. The economy has been more resilient than most people expected at the start of the year. And it has been a better year for markets and also for fund performance. Now, the second thing is, now is only a point in time and things are always changing in markets. There's always the risk that there'll be bumps along the way. And even in the last month, share markets have been a little bit weaker than they have been for most of the year. But importantly, our role as investors is to try and use those bumps in the road to take advantage of opportunities for investors. And you would have heard tonight about some of the investments we've made recently, but even this week, we're seeing our team find lots of new interesting investments around the world, particularly in the US healthcare space at the moment. And we're constantly changing our portfolios to try and take advantage of them for clients. So those bumps in the road can actually be a good thing for investors to help reposition their portfolios. Now, the third thing is really importantly to focus on the long term. We talked a lot about innovation tonight, and the reason we did that is because over the long term, we still see a lot of great things that businesses are investing behind. We see a lot of great growth for some of these listed companies. And as a result, over the next 3, 5, 10 years, we think market returns will be good for investors. One final thing tonight, if you did attend our last roadshow, actually, you'll remember that instead of giving clients a small gift at the end of the roadshow, as we often do, we actually decided to make a donation on behalf of clients to the Cyclone Gabrielle appeal, which was a massively important cause in that rebuild. It's still happening and it's still a very important cause. But we got a lot of feedback from clients that they want to see Fisher Funds, with the size we are now, do a bit more like that. And what we decided this year, we wanted to provide another donation on behalf of our clients. So we thought long and hard about what we'd like to donate to this year. And one thing that's been a real topic this year has been a cost of living crisis, which is impacting a lot of Kiwis. So essentially we decided as a team we wanted to raise some money for KidsCan, which is an organisation that supports young New Zealanders by purchasing things like school books and providing school lunches. Now, instead of just making a donation on behalf of clients and leaving it at that, we wanted to make the team work for it a little bit this year. So the investment team and the advice team decided to enter 5 teams in an ultra marathon. And you'll see that on screen here. Essentially, between the teams, we ran 100 kilometres around Taupo. Now, the team managed to go out there and raise about $10,000 themselves from friends and family, and Fisher Funds has agreed to match that on behalf of clients. So KidsCan will be getting a cheque for $20,000 on behalf of our clients. Now, that's all. Thank you very much for joining us and listening into this presentation. We'll hope you are able to make the next roadshow. Thank you very much.